Hello everyone. In this video, we are going to cover SBITAs, subscription-based IT arrangements, and public-private and public-public partnerships, which are also known as PPPs. We will start by discussing the basic SBITA concepts, and then we will walk through an example of how to apply the new SBITA accounting and reporting rules. We will then define public-public and public-private partnerships and service concession arrangements, and we'll talk about how to report those types of arrangements. First off, we'll start with SBITAs. Essentially, we are just applying lease accounting to software contracts now. The new SBITA accounting and reporting is effective in fiscal year 2023. For our governments with the 6/30 fiscal year end, SBITA accounting started for you on July 1st of 2022. For those of you with fiscal year ends of 12/31, SBITA accounting is applicable starting January 1st, 2023. Now, what is a SBITA? Here's our definition. A contract that conveys control of the right to use another party's IT software, alone or in combination with tangible capital assets, as specified in the contract for a period of time in an exchange or exchange-like transaction. This should sound familiar because it's almost exactly the same definition of a lease. The difference here is that it's specific for IT software. Basically, if you're paying someone else to use their software, you might have a SBITA. One important aspect of the SBITA contract is the subscription term. And the subscription term is basically how long is the software contract. So here are a few specific rules for calculating the SBITA term. First, the subscription term will always include the period that you have a non-cancelable right to use the software. That's called the non-cancelable period. Then you will also add on any extension options if you're reasonably certain that extension option will be exercised. So for example, let's say your initial contract is 3 years, and you have the option to extend for another 3 years. If you're reasonably certain you will exercise that option, the subscription term is 6 years. Then if there's an option to terminate, but you're reasonably certain that option will not be exercised, then you include that additional time. So let's say that the initial contract is for 5 years, but you have the option to terminate after the 3rd year. If you're reasonably certain you will not exercise that termination, then your subscription term is the full 5 years. This does involve some professional judgment because being reasonably certain and absolute certainty are not the same thing. You'll have to consider your government's facts and circumstances to determine this. For example, is the software critical to your operations? If so, you will likely exercise an extension option. Or do you actively have plans to replace the software? In that case, you probably would not exercise the extension option. But this analysis is unique to each government because all of you have unique circumstances. Finally, any periods where both the government and the SBITA vendor can cancel the contract are always going to be excluded. And if both the government and the SBITA vendor have to agree to extend the contract, that period is also excluded from our subscription term. Now, here are a few things to look for when you're trying to identify all of your SBITA contracts. Look at all of your cloud computing arrangements. That could include software as a service, platform as a service, and infrastructure as a service. I highly recommend involving your IT department in the process to identify all of your SBITAs. You should also look at things like cloud-based ERPs and other online items like conferencing, email, and payment tools. Here are a few more ideas of examples to consider looking at. If you have any budgeting software, 911 or emergency dispatch systems, meter reading software, remote learning platforms, data backup and storage, even contracts for things like DocuSign, Laserfish, OpenGov, Zoom, or Microsoft Office 365. Really, any software that you're paying for, you should add that to your list of contracts to evaluate to determine if it's a SBITA. Now that we've talked about a couple things that might be included, let's talk about what is not included. The first one here is short-term SBITAs. And thankfully, the definition of a short-term SBITA is the exact same as a short-term lease. As a reminder, it's short-term if the maximum possible term is 12 months or less. And that includes all options to extend the contract, regardless of whether you think those options will be exercised or not. What that means is if your government has a contract for like an online conferencing tool, such as Zoom or Teams or Skype, but the contract is just year to year or a month to month agreement, and you and that SBITA vendor can choose to stop at any time, that would be a short-term SBITA and not subject to this accounting and reporting. However, if the contract is for longer than 1 year, it would be considered a SBITA. You'll need to look at your individual contracts to determine whether you signed a year-to-year contract or whether your government committed to a longer term. The next exclusion is if you have a situation where your contract is for a tangible asset that also has a software component, and that software is insignificant to the overall asset. An example of that would be leasing a smart copier, where you have the tangible capital asset, the copier, that also has that IT software component. But really, in this case, the IT component is very minor. So that means for the smart copier, you would report the entire contract like a lease. You do not have to try and separate out the software portion and report it separately as a SBITA. Now, if your contract is for IT support services only and not the right to use the underlying IT software, that would not be a SBITA. An example of this would be paying for training for your employees, or if you're paying for troubleshooting or help desk services. If you have a perpetual software license, which we'll talk about next, and then you pay a separate monthly or annual fee for technical support, that tech support is not a SBITA. Now, perpetual license agreements are also not SBITAs. Remember, the definition of a SBITA says that it must be for a period of time. However, a perpetual license gives you access to that software indefinitely, so it's not a SBITA. Let's dig into the perpetual license a little further. Now, perpetual license are kind of the older model for software companies, and many companies are moving away from this to go towards the subscription-based model. And a perpetual license is one where you downloaded the software directly onto your computer or servers, and then you had access to that software forever or perpetually, hence why it's called a perpetual license. One easy way to determine whether you have a SBITA or a perpetual license is to ask yourself, can I still log in and access the IT software after the agreement term ends? If the answer is no, you probably have a SBITA. If the answer is yes, that would be a perpetual license. So let's look at an example. And one of the examples that most people would be familiar with are Microsoft Office products. Now, the older versions of Microsoft Office, such as Microsoft Office 2000, were perpetual licenses. You paid a one-time fee and downloaded it directly onto your computer. You were still able to use the software after it expired. You didn't get updates or security patches past that expiration, but you still had access to use the software. Now compare that with the newer model of Microsoft Office 365. you have to pay an annual or monthly renewal fee. And if you do not pay that fee, you stop receiving access to the software and cannot use it after the expiration. This is a subscription-based IT arrangement. Let's put some of this knowledge to the test. A government signs a contract for an online conferencing tool like Zoom or Skype, and the initial contract is for 1 year. Payments are made each year, and the contract renews automatically every year. The government intends to renew the contract indefinitely. Is this a perpetual license? No, this is still a subscription. Remember to ask yourself, can I still log in and access the software after the agreement term ends? The answer to that would be no. If you don't pay Zoom or Skype their annual fee, they'll cut off your access to their software. That means you do not have a perpetual license. Now, for that same scenario with Zoom or Skype, where the contract is a 1-year term and it renews indefinitely, what's the SBITA term? How do you calculate that? And the answer is easier than you might think. Your term here is only 1 year. At each renewal date, both parties have the option to cancel the contract. If you remember from a little earlier in the training, we said that periods where both parties can cancel the contract are not included in the SBITA term. Those periods are also excluded from the maximum possible term when we're determining whether it's short term or not. But that means the maximum possible term on these contracts is 1 year, so it would be short term. Again, I want to remind everyone to look at your individual contracts. If both parties do not have the option to cancel at the renewal date, that would be a different scenario. Also, if your government signed a contract for longer than 1 year, that would not be short term either. You really have to look at your own contracts to determine this. Hopefully now you have a little bit of a better understanding of what is a SBITA, so let's talk about what to do with them. And for the most part, the accounting for SBITAs is the same as it was for leases. That means we'll record a subscription liability and a right to use subscription asset. The liability is measured at the present value of subscription payments, and it gets reduced as you make those payments. The right to use subscription asset includes a few things. You start with the subscription liability amount, add payments made to the vendor before the subscription term starts. You add capitalizable implementation costs, and you subtract any incentives received from the SBITA vendor before the start of the subscription term. The asset is then amortized over the subscription term. And similar to lease assets, you get to choose the amortization method for the SBITA asset. You can go with straight line or the interest method. Whichever one you pick, it just needs to be systematic and rational, and you should be consistent. That means pick one method and apply it to all of your SBITAs and use the same method from year to year. For any of your short-term SBITAs, you just record an expense as payments are due. So as I mentioned, the SBITA liability is measured at the present value of subscription payments. And you can't talk about present value without talking about the discount rate. GASB tells us that they expect governments to use the rate that the SBITA vendor charges you. The rate could be stated in your contract, and as long as it's a reasonable rate, you would use that for your discount rate. That's probably not the case though. A lot of SBITA contracts do not have an interest rate in them. Instead, you can calculate the rate that's implicit in the contract. GASB Statement 62, paragraphs 173 to 187 give guidance for how to impute the interest rate. Now that method is optional. I don't think a lot of governments are doing this, but I wanted to mention it because it is an allowable method. Finally, the rate is not reasonably determinable you can use your incremental borrowing rate. This is the method I think most people will end up using. An incremental borrowing rate is the estimate of the interest rate that you would be charged for borrowing the subscription payment amounts during the subscription term. Basically, if you went to a bank to finance the purchase rather than making the payments to a SBITA vendor, what interest rate would that bank charge you? So these are the same rules as the discount rates for leases. So hopefully you've established a process for determining your discount rates and can use that process to help determine your discount rates for SBITAs as well. I also mentioned that the SBITA asset includes certain capitalizable implementation costs. For determining whether those costs are capitalizable or not, GASB breaks it down into 3 separate categories. First is the preliminary project stage. This is where you're determining if there's a need for new technology, evaluating the different options you have, and selecting a final software solution. And all of the costs incurred in this phase should be expensed. After you pick the software, you move into the initial implementation stage. And this includes activities related to implementing the software that you chose, such as configuration, coding, testing, and installation. And this stage ends when the software is placed into service. If you have multiple modules, for example, let's say accounts payable, accounts receivable, and payroll, and they're all deployed at different dates, this stage ends when that first module is ready to be used, even if you're going to deploy those other modules later. Generally, the costs incurred in this phase are capitalized. But if you have a short-term SBITA where you're not recording any SBITA asset, then you expense everything in this stage as well. The last category is operation and additional implementation. And this phase includes things like troubleshooting and maintenance. And that additional implementation refers to implementing those other modules that are deployed after you started using that first module. Generally, the costs in this stage are going to be expensed. Now, the GASB statement goes into more details on the implementation costs. So if you have specific costs that you're trying to determine whether they should be expensed or capitalized, I recommend reading the GASB standard and submitting a help desk. Then we can help you get the answer for your specific situation. Now let's walk through an example and look at how to calculate these and what the journal entries look like. Here's our scenario. Government signs a 3-year contract for their accounting software. They must pay $10,000 a year plus sales tax. They also pay $2,000 a year for technical support. The first payment is made on July 1st, 2023, and the government has a fiscal year end of 6/30. Let's talk about what gets included in the SBITA liability. We definitely include the $10,000 contract price for the software. What about the sales tax? No, sales tax is excluded from the liability. Taxes are considered a separate component and are reported separately. Now what about the $2,000 for technical support? That also gets excluded. It is not a part of our liability. Technical support is a service. Your SBITA liability should only include amounts paid for the right to use that software. Both taxes and technical support are not for the right to use the software, so it gets excluded. Now that we know only the $10,000 is included, we can calculate the present value. We take our 3 payments and discount them back to the start of the subscription term. Notice that the first payment, the present value is the full $10,000 because the first payment is made on July 1st, 2023, which is the start of the contract, so no time has passed. In this example, I used a discount rate of 3%. Remember, you'll need to determine the discount rate that's appropriate for your own government. Now this gives us a total present value of $29,135, which is the amount of our SBITA liability that we need for step 2. So now that we have that present value of the SBITA payments, we can prepare our amortization schedule for the SBITA liability. Our first payment here, 100% of it goes to the principal since it was made on the first day of the SBITA term. No time has passed, so no interest has accrued on the first payment. We then calculate the principal and interest amounts for the next 2 payments. We will use this amortization schedule to help prepare our journal entries. We also want to prepare the amortization schedule for the SBITA asset. For simplicity, I assumed that there were no other capitalizable implementation costs. You might have additional capitalizable implementation costs, which you would add to your SBITA asset before creating your amortization table. In this example, I use straight line amortization, which means we're going to amortize the exact same amount each year. As I mentioned earlier, you can choose whether you use the straight line method or the interest method. Now let's look at the journal entries. We'll start with the full accrual accounting, which is applicable to your government-wide financial statements and to your proprietary funds, which are the enterprise and internal service funds. We start by recording the SBITA asset and the SBITA liability at the start of the subscription term, which is July 1st, 23 in our example. Again, in our case, the SBITA asset and the SBITA liability are the same amount of $29,135, which is the present value of our subscription payments. Also on July 1st, our first payment is made. Since the payment is due at the start of the subscription term, 100% of the payment is applied to the principal. And the amounts in this second journal entry here come from our amortization table for the SBITA liability that we created in step 2. And we also had to pay $820 for taxes and $2,000 for technical support. And these are not a part of the SBITA liability or asset calculations. Instead, these are reported as expenses when the payments are due. It's recorded like any other expense. We debit expense and credit cash. In this example, I'm assuming the government made the payment on July 1st when the payment was due. And these payments are going to be made in years 2 and 3 as well. But I'm only going to show you the journal entries for these payments this one time because it'll be the exact same for the remaining 2 payments. Then the whole year goes by, and at the end of our first year, it's time to record amortization on the SBITA asset. So at the fiscal year end, which is June 30th, 2024, we're going to record amortization expense and accumulated amortization of $9,712. And that amount is from the SBITA asset amortization table that we created in step 3. The next SBITA payment is due on July 1st of 2024, so we will reduce the SBITA liability. Notice this time our payment is split between reducing the liability and interest expense. And these amounts again come from our amortization table that we created in step 2. The principal portion of our payment, the $9,426, that reduces our SBITA liability. And the remaining amount of the payment, the $574, gets recorded as interest expense. Now at this point, you would also record the expense for the taxes and the technical support And again, those are the same journal entries that we just looked at. You debit the expense and credit cash. Then at the end of year 2, we record the SBITA asset amortization. It's $9,712, which is the same amount as last time because we're using straight line amortization. At the start of year 3, we're going to make our last payment. The total payment amount is $10,000. The principal portion of our payment, $9,709, reduces the SBITA liability, and the remaining part of our payment, the $291, is interest expense. And at this point, our SBITA liability has been reduced to 0 because we've made all 3 of our payments and we don't owe anything on the contract anymore. And of course, at this point, you would also record the expense for taxes and technical support. Almost done here, just a couple more journal entries. At the end of that 3rd year, we still need to record the SBITA asset amortization, which is our same amount, $9,712. At this point, the accumulated amortization is the exact same amount as the SBITA asset that we recorded at the beginning of the contract. Now it's time to remove both of those from your books because by the end of year 3, you have used up the entire asset and it no longer exists. So you remove them by debiting the accumulated amortization and crediting the SBITA asset. Now let's look at the modified accrual accounting. And this is the basis of accounting used in our governmental funds, which are the general fund, special revenue, debt service, capital project, and permanent funds. In governmental funds, we do not record capital assets or long-term liabilities, which means we can't use the SBITA asset or SBITA liability accounts that we used in full accrual accounting. Instead, in our governmental funds, we're going to record a capital outlay and an other financing source. The amounts that we calculated for full accrual are the same amounts we're going to use now for our modified accrual. We're just going to use different accounts. So at the start of the SBITA term, that's when we record our capital outlay and our other financing source. Then when the first payment is due, since we did not record a SBITA liability, we have no liability account to reduce. Instead, we will use debt service accounts. So for the first payment, all $10,000 is applied to the principal and there is no interest expense. And again, these amounts in the journal entry come from our amortization table for the SBITA liability that we created in step 2. We're just using different accounts now for the modified accrual accounting. Now for the taxes and the technical support, the journal entries are pretty much the same in our modified accrual journal entries. We're going to record an expenditure and then credit cash for the amount paid. Now, unlike our full accrual, we did not record a SBITA asset in these modified accrual funds, so we have nothing to amortize. That means our next journal entry won't be made until we make the second payment. And the second payment, we do split between principal and interest using our amortization table from step 2. And when the second payment is made, again, you would record the taxes and technical support expenditures. I'm just not showing you those journal entries because they're exactly the same as the entry on the previous slide. Now, finally, the government makes the last payment. So they're going to debit the debt service principal and the debt service interest expenditures and credit cash. And that's it for the modified accrual accounting. Our next example is how to record a prepaid SBITA. I've received a few questions about prepaid SBITAs, so I thought it would be helpful to walk through an example. So in this case, we have a 3-year contract, but this time, instead of paying $10,000 per year, the government just pays all $30,000 up front. So how do we account for this? Well, we have no SBITA liability to report. You paid the entire thing up front. You don't owe anyone any money, so there's no liability to report. But you do report a SBITA asset. Remember, the SBITA asset starts with the liability amount, then you add in the payments made to the vendor at or before the start of the SBITA term. And that's essentially what a prepayment is. It's a payment to the vendor before the SBITA term starts. So here are the journal entries for the prepayment. On the day the government makes the prepayment, which in our example is July 1st, 23, they record a SBITA asset for the full $30,000, and the credit is to cash since they paid cash. Now in the past, you probably called this a prepaid asset, but these should be reclassified to SBITA assets. This payment is giving you the right to use someone else's software, so it should be classified as a SBITA asset. Now, after recording that SBITA asset, you're just going to amortize it over the subscription term. So I'm going to show you straight line here. Since the total asset was $30,000 and the contract is for 3 years, we're going to amortize $10,000 each year, which means it just gets recorded as an amortization expense. The last 2 years are also pretty straightforward. Again, we're just recording the amortization expense of $10,000 in each year. At the end of the 3rd year, the accumulated amortization will equal the SBITA asset, and you would remove both from your books. Since the contract is over, you no longer have the right to use that software, so we have to remove that asset and the related accumulated amortization. You do that by debiting accumulated amortization and crediting SBITA asset for the full $30,000. Now we're going to shift gears a little bit and talk about public-private and public-public partnerships, also known as PPPs. A PPP is an arrangement in which a government, called the Transferor, contracts with an operator to provide public services by conveying control of the right to operate or use a non-financial asset, such as infrastructure or other capital asset, for a period of time in an exchange or exchange-like transaction. That probably sounds familiar because it's really similar to the definition of a lease. This time, in addition to a tangible asset being leased, there's also a public service being provided by the operator. Hopefully this visual makes it a little easier to understand. On the one side, we have the government transferor. In order for this to be a PPP, the transferor must be a government. On the other side, we have the operator. The operator can be another government, in which case this would be a public-public partnership, or the operator can be a non-government entity, in which case it would be a public-private partnership. In a PPP, the transferor is giving the operator the right to use a public asset, and the operator is agreeing to provide a public service. The transferor pays the operator to provide the public service, and the operator pays the transferor for the right to use that public asset. You can think of the transferor like the lessor. They own the public asset, and they're letting the operator use it for a fee. You can think of the operator like a lessee. They are paying to use the government's public asset. The main difference between this and a lease is that the operator also must now provide a public service. Now, in addition to the PPP, there is a service concession arrangement, also called an SCA. And this is a special type of PPP. It must meet all of the following criteria. The transferor receives significant consideration. This can be a large cash payment from the operator, or the operator can construct a new asset that the transferor will own, or if the transferor has an asset that needs significant constructions or repairs, the operator can fix up the transferor's asset. In an SCA, the operator is going to be paid by third parties, by the people that they are providing services to, rather than being paid by the transferor. And the transferor gets significant control over the public services. They get to decide what services are provided, who they are provided to, and the prices that can be charged to the users. The transferor would also be entitled to a significant residual interest in the underlying PPP asset. And that just means that the asset will belong to them at the end of the arrangement and it'll have a useful life left in it. Well, here's a visual of service concession arrangements. You'll notice a couple things are the same as the PPP slide. The transferor is still giving the right to operate the public asset to the operator, and the operator is still agreeing to provide that public service. What's different here is that the operator is giving significant consideration to the transferor, and the operator is being paid by those third-party users to provide that public service, rather than being paid by the transferor. An example of an SCA would be a toll bridge. So let's say the government has a toll bridge that needs significant updates or repairs. The operator agrees to perform those repairs, and the transferor continues to own the toll bridge. Paying for those big repairs would be the significant consideration. The transferor is giving the operator the right to use that toll bridge, which is the public asset. And the operator is agreeing to run the toll bridge, which is providing a public service. And the operator is going to be compensated by the people using the toll bridge rather than the government paying them for the service. Now, in this case, the government would also be able to set the prices that the operator is allowed to charge for the tolls and determine who the operator is required to provide the services to. So the PPP term follows the exact same rules as a lease term and the SBITA term. You include the non-cancelable period, and if either the operator or transferor have the option to extend the contract, and it's reasonably certain they will exercise that option, then that additional time is included in the term. If either the operator or transferor have the option to terminate the contract, and it's reasonably certain they will not exercise that option, then the additional time is included in the term. If both parties have the option to cancel, or if both parties have to agree to extend, those periods are excluded from the PPP term. Now, how do we account for these things? There's a few different types of PPPs, and they have different accounting rules. So starting with the transferor side, the first scenario is if the PPP asset is an existing asset of the transferor. In that case, the transferor continues to report that asset as their own capital asset. They're also going to record an asset for any improvements made to their asset. And those improvements will be measured at the acquisition value. The second scenario is if the operator is either constructing or buying a new asset for the transferor, and the arrangement meets the definition of an SCA. In this case, the transferor is going to record that new asset as their own capital asset right away. And that asset will be measured at acquisition value. Our third scenario is if the operator is either constructing or buying a new asset for the transferor, but this time the contract does not meet the definition of an SCA. In this case, the transferor is going to record a receivable for that new asset. And that receivable will be measured at the operator's estimated carrying value of the asset on the expected transfer date. Basically, what that means is the transferor is going to estimate the operator's carrying value on the transfer date and record that as a receivable. And then for all PPPs, regardless of what type they are, the transferor will record a receivable for installment payments if there are any, and those just get measured at present value. Finally, the transferor will record a deferred inflow for all of those items we just talked about, plus any payments received from the operator at or before the start of the PPP term. Now let's look at the operator accounting and reporting. So we still have the three different scenarios, but this time the accounting and reporting is the same if it's an existing asset of the transferor, or if the operator is building or buying a new asset and the arrangement meets the definition of a service concession arrangement. In these two scenarios, the operator will record a liability for installment payments, and those get measured at the present value. And they will also record a right to use intangible asset. That right to use intangible asset includes a few things. You start with the liability amount, you add any other payments made at or before the start of the PPP term, you add the cost of any improvements made to the asset, any initial direct cost to get the asset into service, and if this is a service concession arrangement, the operator will add the cost to purchase or construct that new asset. In the third scenario, if the operator is buying or building a new asset and the arrangement does not meet the definition of a service concession arrangement, this time we will still record a liability for installment payments. But what's different is the operator will recognize a capital asset for that new asset that they purchased or built. They're also going to recognize a liability and deferred outflow related to that new asset because they'll be required to give ownership of that asset to the transferor at the end of the arrangement. So the liability and deferred outflow will be measured at the operator's estimated carrying value on the transfer date. Now, we don't expect a lot of local governments to have these types of arrangements, but a few of you probably do. So if you have a PPP and you need help evaluating whether your contract meets this definition, I highly encourage you to submit a help desk. And then we can look at your specific situation and help you with the proper accounting and reporting. Thank you all for watching this video, and remember to submit a help desk if you have any questions.